Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover many topics related with balance sheet and statement cash flows. In this video, we're going to discuss how to use ratios to analyze operational risk of a firm. Talking about risk, we have to categorize all the risk into two buckets, short-term risk versus long-term risk. When we analyze short-term risk, we're trying to answer the question about, can the firm pay short-term obligations like workers' wages in time? Talking about long-term risk, we're trying to answer the question about, can the firm pay long-term obligations like long-term bonds, long-term debts in time? In terms of the short-term risk, here we're going to talk about three major ratios frequently used by people. First one, current ratio. It equals current assets divided by current liabilities. Current assets are those assets expect to be able to be converted to cash within 1 year or one operating cycle, whichever is longer. Current liabilities are those liabilities due in 1 year or one operating cycle, whichever is longer. So the numerator and the denominator here is pretty matched with each other. So this ratio can tell people how much current asset this company has to cover every $1 of current liabilities. So this ratio measures solvency in the sense that current asset can be used to meet current liabilities, and hopefully this ratio is higher than 1 for a company. The second ratio we're going to talk about to measure short-term risk is quick ratio. So quick ratio here is very similar to current ratio. We're still talking about current liabilities, whether this company has capability to pay off current liabilities in time. But numerator is different. Quick ratio's numerator includes cash, marketable securities, and accounts receivable. This is what we call quick assets. Quick assets are part of the current assets. So when we calculate quick asset, we kick out inventory, we kick out prepaid expenses because we don't think these two items are as liquid as the rest of those three items. So numerically speaking, we can see that quick ratio is going to be smaller than the current ratio. So we always think that a quick ratio is a more conservative test of the short-term risk. This ratio provides a more stringent test of a company's solvency. Sometimes people call it an asset test. The third ratio we're going to talk about here is cash flow from operation to current liabilities ratio. It equals cash flow from operations divided by current liabilities. Cash flow from operation, this measure, can be found in the statement cash flows. So this ratio is measuring the ability of the firm to pay current liabilities using the operating cash flow generated from their internal operations without borrowing, without additional investment. Let's talk about long-term risk. Here, we're going to talk about three important ratios measuring long-term risk. First one, debt to equity ratio. It equals average total liabilities divided by average shareholders' equity. This ratio conveys two pieces of information to the outsiders. First of all, long-term risk. Apparently, the higher the total liabilities, the higher the debt to equity ratios, the larger the long-term risk. Secondly, it is a percentage of total financing provided by debtors or creditors. So it also measures the capital structure of this company. The second ratio we're going to talk about to measure long-term risk is this cash flow from operation to liability ratios. It equals cash flow from operations divided by total liabilities. So this ratio tells people that how much operating cash flow this company has to cover every $1 of total liabilities. So it measures the ability of the firm to pay all the liabilities from cash flow without new debt, without additional investment. The last ratio we're going to talk about here is this interest coverage ratio. This is a ratio to measure long-term risk. It equals net income plus tax expenses plus interest expense divided by interest expenses. The reason we add tax expenses in the numerator is because interest expense is tax deductible. This ratio tells people that how much funds this company has to cover the interest expense every year. So it tells people the relative protection that operating profitability provides to debtors. The higher this ratio, the more likely this company will be able to pay off the interest expense.